So in follow-up to my quirky Twitter video on the case that central banks are taking rotational action, which is while the US is slowing down, Japan and Europe are speeding up on tightening liquidity conditions by raising interest rates. So if you saw that video, we sort of saw Japan follow up because it hadn't done so last week after both the Bank of England, the ECB spoke, and the US Fed took its rate decision. We finally got Japan jumping in this morning and raising its yield curve control, as they call it, because they put the yield curve at they'd said rates will be stuck at 0.25%, which means they were the buy of last resort in the Japanese bond market. And now they've changed that to 0.5%, which means they'll continue to buy at this higher rate bonds. But even of a larger value, it's gone from 7 trillion to 9 trillion. So they've actually increased the amount of bonds they will buy, which will sound like weakening the yen. But at the same time, they are raising rates, which is tightening liquidity. It's a very, very tricky situation. So what does it really mean at the end of the day? Now, if everybody is raising rates around the world, it will feel like the dollar should remain stagnant because the dollar is nothing but yen plus euro. I mean, euro is of course 56% of the DXY. And then you have the yen at 9% and then everything else following after that, from the krona to the Swiss franc and so on. But these are the biggest two components. And so will it mean that the dollar goes flat? At least one thing it will mean that it will become less volatile. So rather than say flat. So in an environment where after tightening of conditions, when you actually get economic weakness, usually we've seen historically the dollar tends to strengthen. But because you'll have these differential moves now between different central banks, what you might end up doing is containing the dollar volatility as far as the traded DXY rate is concerned. But here's the catch. Now, if you're really basing your entire analysis only on the rate of change of DXY, then you're going to get into trouble. Last year that was true. This year, what it means is that the tightening conditions are the bigger factor, and so if you end up with tightening conditions, it leads to weaker earnings and it leads to a recession in the US and maybe other parts of the world, because you have inverted yield curves, in multiple countries, maybe half of the countries now have inverted yield curves. Then if the end result, whether it's 3 months or 6 months down the line, is a recession, we are looking at much weaker financial markets. Specifically, when I say financial markets, I'm talking about equities. Also within the dollar pairs, apart from the big ones which are in the DXY, many dollar pairs will also continue to strengthen. They will continue to do what they are doing, which means strengthen, meaning dollar strength against that individual pair. So you will have to study each and every pair separately, each and every equity market separately to have an opinion. You just can't look at the DXY and, go with that, is what I'm trying to say in the near term. Surely it does mean that at some point, maybe the big dollar rally, which I'm expecting, may get delayed. I'm not saying there won't be a short-term one, but to new highs, maybe not right away. It may consolidate more inside this broad range, 116, 104, which we made. And only then, at a later date, go higher once, things worsen, maybe 3-6 months. So we have time basically as far as the dollar is concerned, but not, like I said, individual pairs, whatever setup they show will play out. Like USD INR has a different setup. So let me move on to, scanning through some of the charts to just show you that. And let's start with USD INR, which is the most interesting here. It actually did not break the 20-week average. So I'm actually going to go to a weekly chart. You see, when you look at the DXY, what you find is it broke the 20-week average and went all the way down to the lower end of the range on the Bollinger Band. I think the 40-day may be somewhere out here, which I have not plotted. Okay, but when you actually look at the USD INR, you find that it didn't break. Okay, so it held on to what has been doing here, the 20-week here again, and then went higher. So now you have a pair which is doing its own thing, which is called USD INR, which is closest to us. So that is why I'm focusing on this first. And there also, then when I move short term, we are starting to see higher highs, a 3-wave pullback, another higher high, again a consolidation, which looks like a triangle. It's possible this could be 1, 2, 3, 4. It's possible this could be an extension in third wave doing multiple extensions in 3, but it broadly means that the trend higher is continuation. Okay, so these are individual pairs doing their own thing apart from what the dollar may be doing. We can see that this morning after the Japanese rate action, immediately the AUD is actually weakening against the dollar. So this is a USD AUD. You can see it's surpassed this previous high, which means 1, 2, 3 has started on the way up. and the previous correction is probably over. So it's been a long wait for the next leg up to start for the AUD. Whether it's the CAD should usually follow what the AUD does. So you're seeing higher highs here in the USD CAD. It's just not run away, and I think this provides reason for it to start moving much higher. And usually the AUD and CAD will eventually move in the same direction, though in the short term we actually see a divergence between these two markets, because you can see one of them, you see this, one of them strengthening, one of them weakening even during the recent phase. But now possibly both will align on the upside is how I actually see this this change really develop. So same thing here we are seeing in the Japanese and the British pound as well. They raised rates last week. It should have been a stronger pound, so it was down here, but now it's weakening, more in line with the trend that we will see in some of the other currency pairs. So these are the tricky things, which is why I said we'll watch each pair differently. And of course, the reason for USD GBP to rise is that in the near term. So let us go back to DXY just for the sake of getting the analytical perspective. Is that on the one hand, I have a preferred count that okay, I can fit in a corrective decline to this. It's reached the lower band. Maybe the bull run in the DXY should resume. But something I have not yet published on Indiacharts, the alternate count to this is that why can't we actually take this as a 5-wave decline? And we can, but this 5-wave decline could simply be wave A of a correction, right? So I could say this is wave A of a correction because we have an ending pattern down here, and we also have what looks like a 5-wave decline inside of this. Okay, so I'm sorry, 5-wave decline inside of this like this. So it's possible this is 5A. We do a nice retracement rally as equities are weakening right now, and many dollar pairs are starting to rise. We do a wave B, then we do a wave C, and then the dollar bull market actually resumes. So this is also a possible scenario. I'll probably write about it sooner than later. I didn't consider it earlier, but I just was thinking yesterday, why not? And it's a fairly plausible scenario, especially given what we have now as policy divergences around the world. So when would this larger wave C unfold? This would unfold, I think, at the point where recession hits, when things get really tighter. Till that point of time, while other central banks are trying to tighten against the dollar, you might actually see some weakening again of the dollar sometime into Jan or Feb. So let's see. This is a scenario. It doesn't have to be. This is just my alternate scenario. My preferred scenario is that possibly this correction is over and the dollar run actually resumes on the way up. And so, yeah, I'm just keeping the alternate open in case we don't surpass a certain retracement and start falling again. I'm going to keep that possibility at the back of my mind. So having said that, spent a lot of time on currencies. The main thing is that all this liquidity tightening, and you're going to then start having to measure liquidity tightening than just looking at the currency pair, is what I was trying to think about. Though individual currency pairs like the USD INR for India will continue to show whether we are, what our conditions are, and the direct impact of that is then on equity. So Indian equities along with the currency, now you have put the currency and bond yields both on the same chart, because increasingly I'm beginning to see in India that you may end up with more like a direct correlation of the two markets, which is historically not true. Historically, you weaken your interest rate, lower your interest rate, and the currency weakens. Here you're getting to the point where if the currency weakness is more significant and faster than what we've seen before, then it actually puts pressure on your bond market, which then you have to raise rates to contain the currency movement, and it ends up pushing bond yields up. So we're actually seeing a more direct correlation since September of this year, which historically, like I said, is not true. If you actually draw a broader chart, and you'll actually see that apart from very short term, you find that these two markets tend to be inverted, right? So even if you see it here, it may go up till here, this is going down, and then it's going up, and then this is flat. So there is some kind of inversion. We're not saying it's dot to dot, but broadly the two markets don't signal the same trend medium to long term. Now, of course, in that sense, what I just showed you is very, very short term. That's why I said it's something to watch, whether this short term correlation will really extend into the future. I think it will, but it's something we should watch out for, and that will show that something has changed, something has broken in the system, specifically to that the currency market is specifically currency, I'm saying INR, is therefore we're losing control there for the time being, or maybe some external factors are playing a big role in how it moves. Now, looking at mid and small cap indices, I've drawn actually a channel for this most recent advance, It's much slower than the bounce we saw between July and maybe September. And after this sell-off, then it's been very lethargic. It didn't even take out this high till recently, and that also only intraday. So it looks like a weak setup. In fact, while the Nifty has actually surpassed this high of Jan, or this is October, this is Jan of 2021-22, the mid-cap index is far, far lower. So this is a major intermarket divergence at a very broad level, and shows you that stocks beneath the surface have really not participated on the way up. This is one of the reasons to still continue to call it a bear market rally. And the trolls simply want to come and claim that Nifty is up, Nifty is up, Nifty is up when all the portfolios are down. And this mostly reflects that scenario, that stocks have really not performed the way. And this is a mid cap, not even, this is a small cap. The mid cap index has done at least a little better in terms of retracement, but not gone back to an all-time high. So the thing to watch out near term, though, if this is going to become a bigger reversal, is going to be this channel, right? So this channel line, the bottom end of this channel, which is somewhere here, should be an important breakdown point. If you break through this, it will signal that this three-wave advance we've seen here, even if it's a complex corrective, it's over, and then would mean that this entire move somewhere is over in some kind of complex Z, larger X, and we resume another larger ABC kind of decline phase from here. So that confirmation will come on the break of this channel line, and on the small cap index, that channel line is at around 9850. So that's the level to watch out for on the Nifty small cap in the coming days. Very short term, I think Nifty or Bank Nifty are both showing an impulsive decline. The way I'm really counting this at this moment is this is an initial ABC. So possibly we mark this as W. We got our X, and we are starting down the next ABC. Now the only debate is whether I mark this as A or this is just one of A. I am tending to believe it's just one of A, given how short the retracement bounce was and how quickly it gave up. So it's not like a normal B wave, which would have been a bigger 60% or more retracement. And so in that sense, I would think that we are starting this 1, this is 2. We are starting what is 3 of C on the way down, and it should have much further to go because 3 of A on the way down, and should have much further to go. So when we are seeing 3 of A, we are basically saying A will complete after 5 waves. This is only 1 and 2, and we are going to get a 5-wave decline before it's really over. So this is the picture. And so what we do every day is sit and count these waves so that we can actually conclude where 3 will end. We can also use Fibonacci ratios to make those projections, something that we try and discuss in the Nifty Intraday update, which I usually publish a short video like this, usually 5 minutes or 10 minutes every afternoon to Indiacharts Insider subscribers. So I'll not go into more detail on that, but this is the setup, I think. And there's also this intermarket divergence shorter term between Nifty and Bank Nifty that should be highlighted, because, and so intermarket divergence are usually the sign, it's classic Dow theory, right? The transports not confirming the industrials and so on. That's the classic Charles Dow theory, if you have studied it. So what we see here is that when the Nifty made its new high at this top, of course here the Bank Nifty also was at a high. But eventually when the Nifty did this 3-wave pullback and bounced again, okay, where we are marking X, the Bank Nifty actually continued to make a higher high. So it went to a new all-time high at this point of time. Now this has resulted in what we call an intermarket divergence based on the Dow theory, where one index, which is banking stocks, were not being confirmed by a new high in the main index Nifty, and this essentially has been followed by a decline. So this is what we call as a negative divergence. When at the highs you don't see confirmation, it is a risk. At that point, it's only a risk that there could be a trend reversal, and you become aware of it. And we've eventually gotten one. And within this now, very similar to what we are doing on the Nifty, 1, 2, 3 down. Bank Nifty also, I think this is 1, this is 2, and we have started 3 down. And so this should have a much further to go. In fact, we can even draw, I'm not sure if we can do that. Yeah, we can do it on both indices in different places. We can actually draw a head and shoulders kind of structure, which means we can draw a neckline over here. You notice how this pullback is just a pullback to the neckline. Now, classic theory holds that you measure the size of the head. And if you measure the size of the head from the point where you break down, or you can take it from the point where it pulls back, you take an equally sized move from the head to the neckline, below the neckline. And so that sort of then gives you the level to which the index will go. And I think this will broadly end up pointing somewhere towards 17,800. Now we can also have a similar HNS pattern on Bank Nifty, just at a different point, which is because it's here and here. These are the mild shoulders. Here you had very strong shoulders, okay, big ones. Here you have small left and right shoulders. But we can even say this is a head and shoulders pattern. This is the head, and we can actually make an HNS projection which goes all the way sub 42,000, so somewhere down here. So these are nice structures, and I really like it. In fact, from an Elliott wave perspective, this one is better because you have a clear 5-wave down from the head. So I really like those more than anything else. So this is where we are overall, I think, on these two key indices in the Indian market, and we're going to be matching this change in trend in terms of how it goes on a daily basis. Thank you.